Welcome to You and Your Money. I'm Jim Zahansky, Principal Managing Partner at Weiss, Hale & Zahansky Strategic Wealth Advisors. Let's dive into today's topic.
With interest rates on savings accounts and money market funds around 5% these days, I know a lot of listeners are wondering if they should just park their cash in those vehicles or look at other long-term investment options. So let's start with the pros of savings accounts and money markets in this environment. What are your thoughts?
This question gets right at where we started on the market updates, right? Interest rates.
Wow.
And, we always talk with our clients about if you have short-term needs, in the next few years, take advantage of these interest rates that are high. Money markets at 4.5%, 5%, a little over that, are all really good ways to get higher amounts of earnings on money that you might need now or in the next few years. So there's definitely, obviously those are safe. The principal's safe. You're not going to lose money on what you've put in, and you're earning on an annual basis somewhere between 4.5%, 5%. So for short term, next few years, really positive.
All right. No doubt about the security and liquidity benefits there. That's kind of obvious. But what are the potential downsides, especially for longer term investing?
Yeah, so this is one. So if you need it in the next few years, you're going to probably get somewhere in the neighborhood of 5% today in a money market, depending on which bank or if you're investing in institutional money market shares. The downside potentially, right? We just talked about it, which is if the Fed lowers interest rates or borrowing rates really is what they'd be lowering, which then has an effect on interest rates. You may be earning less over the next year, and that may be okay to you. It could be 4%, it could be 3.5%. We're not exactly sure what that would look like, but that's something that you can't control. That's controlled by monetary policy run by the Federal Reserve. And so therefore, that may be a downside risk to how you're investing in the short term. It just may not be earning as much as it is right now in a year.
What about bond investments? Drill down on that. What's that about?
Well, right, and that's another consideration at this point, right? Is if for this short-term money, if you're playing this, I want to get yield or income, which is the interest you're earning in it. You may want to consider treasury bonds that and lock in the rates while they're higher. If you look at, then these are things that you could buy in short-term instruments in 6 months, a year, 3 years, all the way as much as 20 years. You may be able to lock in a higher rate. So depending on what your investment objective is, if it's the next few years, if you lock in something for 3 years at 4.5%, you may be happy with that. And the downside to that, though, Gary, potentially is it's not as liquid as the money market, right? So if you lock into a treasury bond for 3 years and you try to trade that within the 3 years because you need the money, you're actually not going to get that full yield back. So that's the downside to treasury bonds. But if you don't need that money in the next few years and you lock it in for 3 at 4.5%, obviously you're earning more money than you had.
Good perspective, obviously. Another consideration for longer-term investors is the opportunity cost of foregoing potential stock market returns by staying heavy in cash and short-term vehicles, even at higher rates. What do you think about that? Well,
this is the dilemma between the short-term need, right? Everyone, and we sort of define short-term as a couple years.
Yeah.
Right. And this may be your emergency fund. So if you're someone who spends $5,000 a month, maybe you've got, 4 to 6 months in an emergency fund. So, say you got $30,000 or something like that, $35,000 in a emergency fund. That might be something you put in a money market. However, if you're saving for retirement and your time horizon is 10 to 15 years away, if you're sitting in those yields in a money market at 4.5%, 5%, you're missing out. And if you look at the stock market returns, if you just use the S&P 500 since post World War II, it's averaged about an 11% return. And so while some years have been bad and some years really good, the average you can't debate. So that's why when you think of the time horizon of being longer term for retirement money, if you're just sitting in cash in that, you're really missing out. And that's something we call wealth building, right? When you look at our name at Strategic Wealth Advisors, you don't always need to have a lot of money to build wealth. You're just making a decision between having yields of 4.5%, 5% versus yields at 11%. And the difference between that builds wealth.
Again, great insight always when we sit down. I know our listeners are walking away, hopefully, with a much better understanding of pros and cons. That's what we do. of various options in this rate environment. But before you leave, any final words of wisdom for us today, Jim?
Well, I'm not sure I have
Hate to put
imparted
the
any
pressure
wisdom
on you.
but I would say that the moral of this story is, in the short term, you definitely have to think about taking advantage of the yields that are in money markets, and as interest rates are higher, the risk there is they may become lower. For all of your long-term money, and this gets at sort of having a diversified portfolio, really think about the types of risk you can take, because usually risk is rewarded by markets. And so, I'll just, the simple term of saying the S&P 500 yielded 11% per year since 1957 on average gives you a perspective on how long-term money, when taking some risk, can really benefit and build your wealth. And so those are the two takeaways really is, while yields are enticing in short-term money, definitely use it for that short-term money. But anything long-term, you should be thinking about a diversified portfolio that takes some risk.
Yeah. Complimentary consultation, that can happen anytime, right?
Yeah, absolutely. Our team, works with our clients on this stuff all the time. We listen to how they might perceive risk and try to adjust portfolios that can help them achieve their goals. And that's what we do for a living.
All right. Always good advice. I enjoy our sit-downs. We're out of time here today. Thank you again for joining us.
Thanks for having me, Gary.
Appreciate you very much.
For more information regarding wealth management and customized financial planning with Weiss Hale and Zahansky Strategic Wealth Advisors, please visit whzwealth.com. Weiss Hale and Zahansky Strategic Wealth Advisors offers securities and advisory services through Commonwealth Financial Network, member FINRA, SIPC, a registered investment advisor. Fixed insurance products and services offered through CES Insurance Agency. They practice at 697 Pomfret Street, Pomfret Center, Connecticut 06259 and 392A Merrill Road, Tolland, Connecticut 06084. They can be reached at 860-928-2341. Weiss, Hale, and Zahansky Strategic Wealth Advisors do not provide legal or tax advice. The tenured financial services team strives to support clients in achieving their financial life goals while providing absolute confidence and unwavering partnership for life.